Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Daniel Lam, your host for the podcast. What a difference 24 hours made in finance. Headline CPI rose by 10 bips month-on-month in August, which was above expectations of a 10 bips month-on-month decline. Annual inflation went from 8.5% to 8.3%, which was more than the expectations of a larger drop to 8.1%. Price pressures were broad-based within core CPI. The most important contributors were shelter and medical care. Another area to note was new vehicle, where prices re-accelerated, reversing the falling prices over the last few months. So let's look at the read across for the various asset classes. First up, let's talk about FX, since we discussed that yesterday. The CPI figure basically took out much of the gains that the other major currencies have made versus the dollar over the last few days. It is now almost certain that the Fed is going to hike by 75 bips in the September FOMC, with a 37% probability that they may be hiking by 100 bips. But on the other hand, other central banks are also quite hawkish. So we're expecting the euro and the sterling to be able to hold their support at 0.9850 and 1.15 respectively. Also, we discussed that the BOJ is likely to stay ultra loose, so we're expecting that the dollar yen is likely to break above its high at 144.98. Now let's talk about bonds, which we talked about on Monday. We continue to like DMIG corporate bonds. So now, despite this higher than expected CPI print, subsequent CPI figures may ease as pandemic-related disruptions to both production and consumption patterns unwind. So DMIG corporate bonds is a very good barbell hedge against the risk of potential over-tightening by the Fed, because you will be needing assets that can give you A, some income, while having B, defensive qualities. DMIG corporate bonds are currently yielding close to 5%, which dwarfs the 2.5% yield that we've been seeing for years. And finally, on equities, last night was the biggest drop in US equities over the last 2 years. Looking at the chart of S&P 500, 3,900 is the key level of support, breaking which we may see the index testing 3,700. Now, if you've been following this podcast, you would recall that we've been talking about US equities and rotating that into DMIG corporate bonds, i.e. the barbell approach that I mentioned above. Moreover, perhaps it's time for you to reconsider rotating into Asia ex-Japan equities. The divergence in economic policies, i.e. policy support in China versus policies tightening in the US, remains the major tailwind for China risky assets. Chinese equity valuations continue to be attractive and is currently trading at a 26% discount to global equities. That's all from me today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.